my top 16 stocks to buy for the rest of 2023. Now, I've been updating this list since the start of the year. It started with the top 23 stocks to buy for 2023, and since then I've made some additions, I've made some subtractions to the list. This will follow the same theme. There are 3 new stocks that I'm removing from the list from the previous update, and there's 2 new stocks that I'm adding to the list. The explanations for why I like all of these stocks will be brief since there's so many on the list. However, I have deeper analysis on each of these stocks mentioned in the video on my channel. With that being said, let's get started with the first 2 stocks on my list of the best stocks to buy now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
And the first 2 are Deere and Caterpillar. Now what I have here on the chart is a forward price to earnings ratio and an operating profit margin for the trailing 12-month going back several years. These 2 financial metrics will be the same for all of the companies I will list here. Now what you'll notice is Deere and Caterpillar are trading at forward price to earnings ratios of 13.6 and 11.28, which are not expensive ratios. The average price of a stock in the S&P 500 index is trading at a forward price to earnings of around 18. So this is cheaper than the average stock in the S&P 500. Also, Deere and Caterpillar have done an excellent job expanding their profit margins in recent years. With Deere, you can see all the way up to 23.15% and Caterpillar jumping to 17.62%. Each of these 2 companies' management have said demand for their products remains strong, even though they've both raised prices on their products by double digits to combat inflation. That's good news for investors. The next 2 stocks on my list of stocks to buy is DocuSign and Fiverr. DocuSign and Fiverr, again, not expensive at a forward price to earnings of 15.6 and 14.22. Also, DocuSign and Fiverr have done an excellent job expanding their profitability over the last several years. Now, unlike Deere and Caterpillar, Fiverr and DocuSign are growth stocks, so their actual profit margins are lower at 1.21% and negative 7.54%. But when I'm looking at growth stocks, I'm okay with negative or small profit margins so long as they demonstrate to me that they're increasing their margin over time as revenue is growing. And that's definitely what I see from DocuSign and Fiverr. Over the years, their profitability is improving, and I see no reason why that shouldn't continue over the next several years. The next 2 stocks on my list of top stocks to buy is Etsy and eBay. And again, continuing with the theme, these stocks are not expensive. Forward price to earnings of 13.92 for Etsy and 10.16 for eBay. Operating profitability is heading downward for both Etsy and eBay. Remember, these 2 companies benefited tremendously during the lockdown stages of the pandemic as people were spending more money online. And now that economic reopening has gained momentum, consumers are temporarily shifting their spending to away from home channels, and eBay and Etsy are hurting because of that. However, the thing I like about these 2 specifically is that the e-commerce industry overall is raising fees on merchants, making it more profitable for all e-commerce providers, and that's going to be a tailwind for Etsy and eBay for several years to come. So the 3 stocks that I am removing from my list of top stocks to buy are Alphabet, Starbucks, and Airbnb. Let me go through each of them and why I'm taking them off the list. Alphabet, I'm taking off the list because it's already had a strong start to the year, and I think it's a good time to reduce the exposure to Alphabet if you own Alphabet. Now, I'm still rating Alphabet stock as a buy. I'm just not keeping it in my list of top stocks to buy anymore. Starbucks. Now I'm taking Starbucks off of my list because one of the reasons why I was bullish on Starbucks so far this year and coming into this year was because I was expecting a strong economic rebound in China as that economy reopened. However, all of the data I'm seeing out of China is showing that the economic rebound from the economic reopening is not as strong as I thought it was going to be initially. And so for that reason, I'm taking Starbucks off of my list of top stocks to buy because Starbucks has significant exposure in China. It's where it has the second most stores outside of North America. And so while I'm keeping Starbucks stock a buy, I'm no longer keeping it in my list of top stocks to buy. And finally, Airbnb. Here's another downgrade from Airbnb for me. It's the second downgrade in as many updates because Airbnb has done so well for the year already. Starting the year, I had Airbnb stock rated as my top stock to buy. And it, after rising significantly throughout the year, I downgraded it from my top stock to buy to just putting it in my list of top stocks to buy. And now I'm removing it from my list of top stocks to buy, again, because it's done so well already. And I see the rebound in travel, in spending money on travel, is slowing down just a bit. And that signals to me, with the given the already strong returns from Airbnb, its valuation is now at a forward price to earnings of 32. So I thought it would be a good time to remove it from my list of top stocks, even though I still have Airbnb stock rated as a buy. So now getting back to stocks to buy, and the next two on my list is 3M and Home Depot. Now Home Depot stock trading at a forward price to earnings of 19.24 and 3M trading at a forward price to earnings of 10. Now, operating profitability has been excellent for Home Depot, rising to 14.88% over the years. But what you'll notice here, 3M experiencing a big drop off in profitability. What gives here? And the reason for 3M's drop off in profitability has to do with settling some legal disputes where it's taking the costs right now. However, I don't think this is a long-term issue. I think these are one-time issues that once 3M gets over these, longer term, it's going to be in a good position. So I'm putting these two in my list of top stocks to buy. And also these are dividend stocks. So if you're an investor that likes dividends, 3M and Home Depot offer a nice dividend as well. The next two stocks in my list of top stocks to buy are Visa and MasterCard, two of the most profitable companies in the world. Visa and MasterCard are not as cheap as most of the stocks I have listed so far, and there's good reason for that. Visa is trading at a forward price to earnings of 24 and MasterCard at a forward price to earnings of 33. And if you look at their operating profit margin at 67% for Visa and 57.7% for MasterCard, you'll notice you'll have a hard time finding any other companies in the world that come even close to these operating profit margins. Now, I'll give you a hint. There is one company I'm going to recommend a little bit later in the video that does come close, but you'll notice all of the other companies I've mentioned so far, none of them come even near these types of profitability. And so I'm willing to pay a little bit higher price for Visa and MasterCard because they are such excellent businesses. The next two stocks on my list are Target and PayPal. Again, PayPal trading at a forward price to earnings of 11.5, down significantly off its highs, and Target as well, forward price to earnings of 14.5. PayPal's solid profit margin at 16.68. Target's profit margin at 4.36 is a little bit below its long-run average. Its long-run average should be closer to 6% operating profitability. In the recent years, it's been fluctuating. It jumped to record levels above 8% during the pandemic because it was allowed to stay open while competitors were forced to close. Target benefited from that trend. And then as economies reopened, it's experiencing the downside of that trend, as well as some other issues the company is having that's causing its profitability to fall slightly below its long run average. But I suspect that over the next few years, it'll rebound and it'll continue to thrive, especially because it made very smart investments in same-day delivery services that customers are truly loving. Billions of dollars are being spent through Target's same-day delivery services like buy online and pick up at the Target parking lot. That's really popular with customers, and I suspect that will drive profitability for the company going forward. All right, the next two companies on my list of top stocks to buy. One of them is a new one, and that is Altria Group and StoneCo, which has been on my list for the last few months. These are trading at a forward price to earnings of 12.57 for StoneCo and 8.433 for Altria Group. And I mentioned earlier, you'll see a company that approaches those excellent profit margins, and that is Altria Group at an operating profit margin of 56%, almost up there with MasterCard, very close to MasterCard. And then StoneCo with an operating profitability of 45.56. StoneCo actually has made some changes that I think could boost profit margins even more over the next few years. Management said it's focusing on more profitable customers, and it's not going to focus on customer acquisition, especially for acquiring those customers that are not generating the higher profit margin. So I think that's going to boost StoneCo's profit margins even more over the next few years. And finally, two more new stocks that I've added to my list of top stocks to buy, and that is Six Flags and Booking Holdings. Now, Six Flags and Bookings are benefiting from that trend I mentioned earlier, with consumers unleashing pent-up demand to spend money away from home and not trading too expensively. Bookings at a forward PE of 20.96. To me, this allowed me to benefit from that spend from consumers going away from home, while also not paying as much of an expensive price as I would be for Airbnb. So you notice I kind of swapped the two out. I took out Airbnb from my list and I brought back in Booking Holdings into the list as one that is going to benefit from that consumer trend of spending more money away from home. Also, profit margins, excellent profit margins at 30% and 25.58%, and these could also move higher as consumers continue to spend more money away from home. Six Flags and Bookings will benefit from higher inflation as well as the average prices for their services increase. So there you have it, 16 of my best stocks to buy right now. Now, before I let you go, if you've gained any value from this video, which you probably have if you've made it this far, please subscribe to the channel. It'll help me create more videos just like this one. Thank you so much for watching.